let's pretend that Saudi Arabia and Russia come to some kind of deal. It's really hard to get 6,000 shale players to all agree on something. How much would you be willing to cut alone?
Well, good morning, Alex. Great to be with you again. We are calling for a roughly 20% cut from the state of Texas, and candidly, that might not be enough. What we need is a symphony of solutions. Operators have to do their part. They have to cut. We've seen CapEx cuts to the tune of 60%. But states need guidelines so that this is done in an orderly fashion and fair across the board. On top of that, other countries need to pitch in: Canada, Norway, Mexico, Brazil, and of course, the big kahuna OPEC Plus needs to come to an agreement. They've reset the table. It looks like they're willing to talk to each other again, and they need a dramatic cut as well. So everybody needs to pitch in. This is truly a global problem, and we need a global solution.
I chatted with Scott Sheffield last week of Pioneer, and I tried to ask him how much would you cut on your own, and he didn't really give me an answer. Can you give me some insight into how much you're willing to cut on your own, either voluntarily or involuntarily?
Well, we'd definitely be willing to adhere to the state's 20% if they land at that number or a larger number. We've already cut our CapEx 66% on a go-forward basis. And then we've already started shutting in about 400 lower producing wells. These are low margin wells, even though 90% plus of our wells, of our volumes, have below $5 operating costs. We're some of the lowest operating costs in the country. And this allows us to get out and look at the long-term impact of what's going on right now. So if we don't get a global cut, we saw a week ago Midland pricing at $12 a barrel. That will probably go to single digits. And the United States worker, the Texan worker, 361,000 Texans in the oil patch, and millions across the energy sector in the United States, we're basically going to be exporting those jobs long-term to OPEC countries. Those jobs will not come back. The service sector will be absolutely crushed and devastated, and they'll have no access to capital. Their cost of capital will increase over the next 12 to 24 months. And then that will be passed through to the domestic producers, and will not be able to compete on a global scale.
Matt, those are really staggering statements, and no doubt when you have Exxon cutting 30% of its CapEx, and a lot of it coming in the Permian, that could very well turn out to be true. So what does need to be cut? You mentioned 20% a bunch of times and said maybe it's not enough. Can you give me a perspective of what you see as the supply-demand imbalance? And I mean, we're looking at a global 30% cut. What do you think?
Yeah, you're seeing every week it goes higher as the response to COVID-19 grips the entire planet. So it was 10 million barrels a day and then 20 to 25, and people thought they were out in front on those estimates. We're seeing latest estimates of 30 to 32 million barrels a day in demand drop against an original 100 million barrels a day of global demand. So 32% of short-term demand impact. On top of that, you have about 14 million barrels of Saudi oil sitting on ships coming to the Gulf Coast. This is on top of their historic import rates. If we're going to make these dramatic cuts as domestic operators, we can't just allow backfill to happen from foreign barrels. So Secretary Perry did mention a 60 to 90-day pause on imports as things stabilize. I think that's something the president really needs to look at, and look at that pause, especially on volumes that are above historic norms.
When you take a look at the broader then market, how quickly can you guys shut something in? The rhetoric is that Russia and Saudi Arabia can pretty much shut something in quickly, but that'll be a lot more difficult for shale producers to shut it off as quickly. It'll be more gradual. Can you give me some insight into that?
I guess I actually challenge that view. We have a great team out in the field. We have live data, live dashboards. Our workers get out to every well every day, and within probably a week, we would be able to constrain production and adhere to volume curtailments. So on top of that, our high pressure, high flowing horizontal wells, you can just simply choke them back. You constrain the flow of those wells. There's an unknown impact on the other side of what that will do to the reservoirs, but these are unconventional reservoirs that do not have water drive mechanisms, so we think they're fairly resilient to shut-in conditions. So we will be able to bring them back over time, and we've seen that in operating conditions today when we shut in for offset activity.